All right. Good afternoon, everyone. We are going to talk about Bitcoin financing, quite the hot topic these days, especially as we've seen the growth in the mining industry and in hash price, and also especially with Bitcoin Treasury companies. So we've got a great panel here. I want to start really with mining. We've got some mining experts up here today. How has the capital markets for miners evolved over the last 12 months, especially as we've seen some consolidation and also pivots to AI within the industry?
We've seen quite a bit of evolution in miner financing, I would say, over the last 12 to 18 months. I work for Luxor Technology, and we provide miner financing through hash rate. But to answer your question, I think there's just a lot more options for miners. Even going back like 2 years ago, after the last bear market, it was really hard for miners to get access to financing to fund the growth. Right now, in terms of funding growth in either mining or HPC, there's a lot more access to capital. So for us, like what we've seen is just a massive explosion of options for miners to get that access and the growth that comes with it.
How about from the Antalpha side?
Thank you. I work for Antalpha. It's one of the largest financing firms for Bitcoin mining facilities globally and also in Bitcoin. The market structure changed tremendously in the last 12 months. On the middle and small size sector of miners, a lot of them were able to basically pay their loans and switch more to Bitcoin loans than to mining loans, just because they want to pay the debt and move on and scale their facilities. So a lot of them did that. On the energy loans, we offer also electricity energy loans, basically. Those are very sticky because energy price is also going up and a lot of miners continue to pile up on that product. For the larger miners, as Matt mentioned, they have more options, also more capital market options. Some of them are public, some of them are to be public. They have more access to capital. So it really depends on the tier and the location, but we see a lot of them focus basically on paying their loans and scaling, basically getting loans for new facilities and better hardware and such.
I would add that the cost of capital has come down quite a bit, especially over the last 12 months. Again, going back to like 2 years ago, miners were seeing, high teens cost of capital, and now that's compressed quite a bit. And I think it's natural once you get a lot more options for financing, the cost of capital comes in quite a bit. But, we've seen sub 10%, depending on the type of loan they're getting. The Bitcoin denominated loans we're seeing, all the way down to 6-7%.
Is there a meaningful difference in that cost of capital for the publicly listed miners versus smaller private entities?
Meaning, like, is there a difference between the two?
In terms of the cost of capital?
Yeah, definitely. The cost of capital actually comes down quite a bit depending on a number of factors. One, the creditworthiness of the counterparty is super important. So even amongst the publicly traded mining companies, there's a pretty big divergence in creditworthiness. And then the collateral, obviously. So whatever the LTV of the loan is, obviously will drive down the cost of capital.
And what financing structures in terms of, you've got straight bonds, you've got convertibles, you've got Bitcoin-backed loans, you've got equipment loans, you've got electricity loans. What structures are you guys seeing done in the market right now, and what's really the most competitive option for a miner?
So this is a very good question. Again, miners have the full menu to access those products. But what we have seen recently that more and more miners are investing to get loans to build new mining facilities in new jurisdictions that have cheaper access to energy. It's really nailing down to more energy costs and scalability and navigating the regulatory environment for new, basically, jurisdictions. And this is what we are seeing. A lot of miners already are in Texas, already are in Middle East already, but they are exploring Africa, they are exploring South America. And being able to underwrite risk and scale there, this is a competitive edge for companies like us or for the miners to be able to compete in the industry. But to answer your question very directly, like Antalpha, we offer very standard products. We don't do leverage. We do everything like oversecured and such. So our rates are more sensitive to the SOFR and the Fed fund rate less sensitive to the credit of the client, just because we have very standard set of products and structures. But the energy loans and the scaling mining facility loans continue to be our big products. And a lot of the older miners, Bitcoin loans are also big product because they already accumulated Bitcoin for a long time. And now they want to have access to it to do maybe other things or buy real estate in Miami or something else. But this is what we are seeing.
Yeah, I would add one thing to that. When you mentioned you're seeing a lot of is the over collateralization. There's a lot of Bitcoin-backed loans out there. But what's really interesting to me is the collateral terms for these loans are pretty crazy, if you ask me. Like people are asking for 120, 150% over collateralization, which a lot of the miners are willing to do because they're just sitting on the Bitcoin anyway. So they have a hodl strategy many times that Bitcoin's idle, so they don't mind over collateralizing. So I think, to answer your question, I think you're seeing a lot of the, Bitcoin-backed loans being put to use.
And one more area to add, miners now are more strategic and they are looking more for longer term loans that are aligned with their structures. And not just Bitcoin miners, also Bitcoin treasury companies and such. They are looking for structures where it's usually beyond 1 year, has competitive rate, and structured in a way that is aligned with their business. And this is a signal of matureness in the space, less of miners just trying to live day by day like 5 years ago and just trying to break even. So we like that. We like the new structures, and we see more public companies and others looking for doing convertible note structures and treasury products with crypto native companies because they can be more aligned and more positioned to offer better financing terms.
In terms of those longer term products you just mentioned, how mature has that industry gotten? Like what types of term loans are you seeing in the market?
From like sizable numbers, we see one like up to 3 years is very liquid, and actually we offer this kind of range, but we are exploring up to 5 years as well.
We're seeing on the shorter side. I think the markets that we operate are more in the 1 to 12 month or even 18 month. And the reason the markets that we operate are basically miners can sell their hash rate forward and get the Bitcoin up front. And so naturally for those types of products, they're taking the assets that they already have, paying it back through our mining pool, but those need to be shorter durations just due to the risk involved with it. But I would agree. We are seeing, on the other more traditional type loans, they're going out, 3 years. We're seeing a lot of that. I think a lot of times miners are trying to line up the duration of the term with the machines that they're purchasing, the life cycle of the machines, and that could be 3 to 4 years. So, usually that's the term that they're looking for.
Yeah, actually, you're right. I mean, for us, we do 2-year standard for new mining machines because this is the average expected span of having productive hardware, basically, chips. So we do standard 2 years for mining facilities.
Great. Well, I want to zoom out a little bit from mining and kind of just talk about the broader Bitcoin market. We've seen these Bitcoin credit expansionary cycles. Being one of the things that really drives the feeding frenzy and risk-taking in bull markets, but also something that causes a lot of pain on the way down as that credit cycle contracts again. Where do you guys think we are in the landscape of that expansionary credit cycle in the Bitcoin landscape today?
Well, so first off, I don't know anything about mining, so I really couldn't comment on the former topic. And second off, Tyler is our quant, so for all the hard questions, I really just defer to Tyler to answer for us. In terms of where we are in the credit expansion for the Bitcoin ecosystem, and it's going to be interesting to actually see, like, as the Bitcoin markets and the TradFi markets merge together, maybe the credit dynamic that exists in the TradFi market bleeds into the Bitcoin market, and they become more interconnected. Bitcoin doesn't have its own credit expansion process per se, but right now they're pretty segmented, and I'd say we're very early. I mean, from the digital credit perspective, you can look at how levered up Saylor is, and I think Saylor's like the most levered in terms of issuing all the preferreds and securities that he has. And relative to how levered he could get, I think we're in the first like 10% of the credit expansion phase. I think he's talked about a 30% number. Right now, I think he's closer to 10%. He's under 10%.
12%, yeah, 15%.
So, and I think as that number expands, not only does the dollar sum get very big, but also the price of Bitcoin will be going up over that period too. So I think we're in the like very opening stages. And I think for most of the Bitcoin treasury companies, they're trying to figure out what debt instruments they want themselves. And they're at the very beginning stages of that.
I would totally agree with that. I would think of it not in terms like a cycle, but more where we are in the maturity path. And I would definitely agree with you. I think we're pretty early in the maturity path. And I think that, there's quite a few ways to go here. But, I like what you said. I think there is a blending of traditional markets and Bitcoin markets that is happening right now. But, as more people come into the space from traditional markets, it's natural that it's going to happen. But I would totally agree with you.
It's also been interesting to watch the competition. And Derar, you mentioned this. And, right now we're actually exploring a deal with Antalpha. So I like this. This is a good topic. But, how many people in this room have ever taken a loan against their Bitcoin? I'm curious, actually. Raise your hand if you've taken a loan against your Bitcoin. Okay, look around, people. We're early. All right. When the majority of this room raises their hand, you need to be closing out your credit. But what's been interesting to me is, like now from Bitcoin market participants from an Antalpha, I could borrow $500 million from Antalpha. I mean, that's insane. I mean,
you already did 200 million.
I've already borrowed 200 million from them. So, like that's typically money that you would get from a Wall Street firm or from a major financial institution. And now Bitcoin firms are really able to compete head to head in terms of size and capital that you really could only get from very few sources earlier. And I think that creates a very competitive landscape. And it's kind of awesome. It really is kind of shaking up, I think, the balance of the lending markets. And I think it's really just beginning as these balance sheets keep growing. The size of these loans are just going to get bigger.
Yeah, I just want to add two key elements to the credit market. Since the last crisis, I believe there is a lot less leverage in the ecosystem. All companies, small or big, they think about risk differently, especially credit risk. But I think on the broader market in general, I think having the ETF market and now allowing in-kind contribution to the ETF market will allow people to be able finally to have a prime broker model where people can have exposure to their portfolio much easier. They can do in-kind contribution to ETF, then they can borrow margin against that, then they can buy other things or borrow against it. So I think the credit market is going to explode in the coming few years. Now we are on the early path. And there are more and more instruments, standard instruments that fit within the capital markets regime now that people will be able to, that fits their risk parameters. Think about pension funds, think about public companies and such. And they will be able to take a credit from traditional banks and beyond in an easier fashion and more standard way.
You mentioned the health and kind of the risk management across the industry. What are some of the factors that you guys look at, particularly as lenders, to kind of assess that overall health and when firms are starting to get over levered, or gauge your temperature on where you think that risk is at?
For us, it's going to be our two answers are probably going to be very different. For us, we need to assess the health of the miners. So we have a pretty robust credit profiling process. So we'll look at the miner. If they're a publicly traded company, it's much easier. If not, we have to ask for lots of financials, balance statements. But we want to know what their what we call it hash cost, like what it costs for them to mine. We need to know what their break even is when determining how much money we can lend to these miners. So we'll look at what their energy costs are, what their operating costs are. Do they have redundancy? Like, meaning, do they mine in different locations across the world? Like, those are all very important things to us. And then we look at the performance metrics too. So these miners will be on our mining pool, and we can look and see what their uptime is, how much hash rate they have, does that fluctuate, is it growing? So for us, it's really just assessing the health of the miner, and we don't like to say no to anyone, but depending on the answer, it's a function of what the interest rate's going to be and how much we can lend them.
I think there's also, this isn't really answering your question about the credit health of these companies, but I also think there's a lot of complexity that can get layered into these credit products that kind of like keep taking us to a new frontier of them. Tyler, maybe explain the product you were just pitching upstairs. Like, you can do some pretty interesting stuff here when you add leverage on top of credit. And, the pitch you gave was like, okay, take your Bitcoin, use that, borrow against the Bitcoin, take the cash, buy STRC or buy the European equivalent STRE, borrow that money against your Bitcoin at 7% or borrow against the shares themselves, STRC at 4.5%, and you're getting a dividend of 10.5%. And so you lever that baby up, and then all of a sudden now you're yielding 20% plus. Like, okay, like there's a lot of interesting stuff here that you can cook with, where if I was able to hold my Bitcoin and get a 20% dividend on my Bitcoin off of a Sailor's preferred, that's interesting to me, especially when we're at the beginning of the credit expansion phase and not at the end of the credit expansion phase.
That idea sounds super scary to me. All you kept saying was, it's all leverage, man. Nothing could go wrong.
Yeah, for us about risk management, I like to call us more like Bitcoin financing firm, less of a lender, just because we really partner with the client. We call them partners. The reason is we underwrite the whole cycle. We underwrite the new side, the electricity source, the land, the regulation, the machines, the hash power. We underwrite the whole facility. And then we offer the loan on that facility based on those parameters for 2 years, which is the lifespan, expected lifespan of the facility. So we pretty much don't take any risk on that front, just because we see the whole life cycle of it. And then on the Bitcoin loans, we do very standard, like a 60% LTV, all of that. So some people that doesn't fit them, it's okay. We don't do those loans anyway. So there are other people who like to take more risk, more leverage. It's fine. But we cover that market sector who are truly Bitcoin people who want to be in the market medium to long term, not people who are trying to enter and exit certain cycles. And this is the kind of partners we work with. And aside from that, we are comfortable with the swings of Bitcoin. And because we are long Bitcoin, long hash rate, even we never liquidated the client actually. Sometimes clients say, I cannot afford it. We might buy the facility back from them, add it to our portfolio. And this is differentiator of someone like Wall Street lender who just wants to get their money right now, liquidate right now. That might not suit an industry like miners who go through different cycles and support them. So anyway, we take risk management very seriously, but we also act on it. So yeah, and very similar, like you have to be very technical in this field. You cannot just look at balance sheets, and that's not sufficient.
It's probably easier to go through credit profiling if they're over collateralizing, right? It becomes less of a concern to you. For us, I mean, it's super important because the collateral that we're taking is hash rate. It's not Bitcoin sitting in a tri-party. I mean, sometimes it is, but if we're extending credit to a miner and they're just, collateralizing in a hash rate, like creditworthiness is super important to us. But I think on these loans here, we're seeing, from the you guys operate or Coinbase, just on the other ones where they're taking 150% collateral, you're not as worried about it.
Right.
Now, for the Bitcoin Treasury company space specifically, like what you mentioned, Sailor targeting kind of 30% leverage on his Bitcoin equity. What are the most, elegant and the most popular ways for a Treasury company to achieve that leverage today?
There's a variety of different tools, and I think the market right now is also quickly learning about what's available to them. I'm used to the world of Bitcoin-backed loans where you're an individual user and you don't really have much negotiation power, and I mean, it's a very different world than when you're an issuer and you're dealing in large sums of money. I think what's been a popular structure, one that we've done, is a convert. I think that one of the challenges with the convert is that, typically when you're doing converts, there's someone who's arbing the convert on the other side. And so you can have a really low cost of capital, but you can pay for it in other ways. Like you can pay for it with your stock getting shorted, for example. And so not all of these are exact apple to apple comparisons. I think, the Bitcoin-backed loans are popular, converts are popular, but I think the market's also, really assessing these preferreds. And what's nice about the preferreds is that at the end of the day, you have a lot of flexibility as an issuer. The challenge is that, yes, you have a lot of flexibility, but if you actually use that flexibility in like the time that you might want to use it most, it's very damaging to do so. If like Saylor can suspend the dividend if he wants on these preferreds at any time, but if he did, it's going to be really bad. It's going to be a long time before he's going to be able to issue any new securities. So, there's some trade-offs of, he's paying a higher cost of capital, he's getting more optionality. Whether that trade-off is worth it, we'll kind of find out.
I'm kind of the opinion that I agree with everything you said, but I'm kind of the opinion rather than focusing on levering up, I think they should be focusing on how to deploy the capital that they have. I think what's interesting to me is, follow the Treasury space pretty closely, is you're not hearing much about how they plan to deploy or what their business model is. I think there's a lot of Treasury companies that are just Treasury companies for Treasury company's sake, which I think is wild, and again, what could go wrong? But I would like to see more of unique structures of deploying that capital and growing that Bitcoin, Bitcoin yield strategies. There's a lot of different ways you could do it, but you're just not hearing much about it. And I think, going back to where we are in the maturity path, we're at 0 right now in terms of Treasury companies. I think there's just a lot of room to grow, and I'd really like to see in the space, what they plan to do.
Yeah, I mean, I look at Bitcoin treasury companies as like the Bitcoin version of a bank. And, banks are kind of like the fiat treasury companies of the TradFi world. And you're in the business as a bank of monetizing your balance sheet. And if all you're doing is levering up the balance sheet, but you're not monetizing in any way, you're kind of missing the picture of what you're supposed to be doing as a bank.
I mean, it seems like there'd be an opportunity for treasury companies to be lenders themselves.
Agreed.
Well, our panel here is called The Future of Financing. So I wanted to look ahead a little bit. What structures do you guys think are new, innovative in the market? What do you think will dominate the next 5 years of Bitcoin credit? Whether it's Bitcoin-denominated convertibles, whether it's hash price future forward contracts, whether it's Bitcoin-denominated prefs. What does the future look like?
The future's here, man. All those things you listed, we're doing already. So the company I work for, Luxor, we have hash rate markets. There's hash price forwards already that exist. We have a structure that I mentioned before where, you can sell your hash rate in the future and get your Bitcoin now. I think all those things, they exist already and those markets are fairly robust. But I think to your question, where does it go from here? I think it just gets bigger and more sophisticated. So when we first launched our product, we were only doing a couple, tens of millions in notional a year. Now, we were talking about this earlier. We're close to, we're going to be hit close to $1 billion in notional this year. So it's
off your hash rate contracts?
Yeah, we've already 20x last year.
Wow. Congratulations.
Thank you. Yeah, it's been wild. And the reason is, I think to answer your question, is you're getting more and more institutional players that are coming in. So, our customers on the lending side are banks, are spot exchanges, are treasury companies, hedge funds, family offices. So I think the future really is just, you'll get more sophisticated instruments that exist that are borrowed from traditional finance, but it's just, you're going to see more and more players in the space that had traditionally shied away from it, which will drive down cost of capital too.
Yeah, I think more digital credit products in more currencies from more issuers. I think cost of capital is going to keep coming down. I'm surprised to your point of how much it's come down, and it seems like it's even coming down more. I'm guessing that's just from capital flowing in from the TradFi world that has access to the Fed.
Oh, it's wild. Like our first deal we did was I think it was 16% was the cost of capital, and now we're in the low single digits. So it's crazy.
Yeah, and I think one of the areas that I think is an interesting place for some greenfield for expansion is on really identifying some of the credit risks that can be uniquely mitigated through Bitcoin. And so we've looked at products before like Bitcoin denominated convertible notes, which is an interesting product. One of the challenges with a Bitcoin denominated convert is that, if I choose not to convert, I'm dependent upon the person that I lent to return the Bitcoin to me. And what if they decide they don't want to return the Bitcoin to me? So what if instead I could leverage the actual technology of Bitcoin, and I could do a Bitcoin denominated convert, and I could do it in a multi-sig wallet where, if I haven't converted within some time period, I'm able to actually pull the money back myself. And so, that would be a substantially lower risk convert for us to do. And if it's lower risk, then in theory, we should be willing to accept a lower interest rate. So I think there are some superpowers Bitcoin has, and as those get brought to bear, it'll be interesting to see how they impact the credit products.
I think the products we have already, we are the future, is going to continue to exist. Just thinking about the geopolitical risk and inflation globally, we are going to see more and more Bitcoin gold secured products. You are going to see more and more people looking at maybe Bitcoin is not the best for people in India, Middle East. We at Antalpha, we are really investing a lot in gold and Bitcoin, but also most importantly, I think we are going to see more and more energy products. People might say, if I invest in energy, it's going to be cheaper correlation to Bitcoin. So we see that's why investing in energy infrastructure is going to be very important product to correlate exposure to Bitcoin and beyond.
And if I could just piggyback, one more thing I think we're going to see the Antalphas of the world and the Coinbases of the world and the Zappos of the world, their lending activity is going to ramp up, and we're going to start seeing billion-dollar loans. And I think we're going to see Bitcoin and crypto firms arrive in the global financial system as actual financial institutions. And I think that's going to be pretty exciting to see.
And Nakamoto will be the future Federal Reserve.
That's right.
All right. Thank you. Thank you, everyone.
Thank you very much.
Thank you.
Thank you. Thank you.